All right, welcome back. We touched on this a bit last week, right? When I thought more about it over the weekend, the more I felt uneasy about it. So I want to talk about it again, right? We told you that the owner of the New York Stock Exchange, which is the Intercontinental Exchange, boy, oh boy, they're in a deal entering into with Polymarket. That's a betting website where you can basically bet on anything you want, like how long is Pete Hegseth going to stay the Secretary of Defense, right? And then we learned also that the CME Group and Fanduel are joining forces so you can bet on, say, economic indicators and sports. Now, I've spent a large portion of my career trying to convince the general public that shares and commodities, they were tools to hedge risk and manage your wealth and to maximize returns. There was an important economic function that was behind it all. And the pomp and circumstance was just kind of a cover. But now it's going to be harder to have those conversations, right? And I get why the exchanges want to get in the business. Based on data from the American Gaming Association, Americans legally wagered nearly $150 billion on sports in 2024. And that's a significant increase of 24% from the year of 2023. So I'd like to get my thoughts on my next guest on this subject. Please welcome to the show, Rebecca Walser. She's going to have an interesting point of view, I'm sure. Rebecca, again, just to reiterate, I've spent my entire year trying to convince people that the Chicago Board of Trade and the New York Stock Exchange were not gambling halls. And now it looks like I've got a little egg on my face. What say you?
Well, you should have been right. Okay, that's the point. You should have been right. I have a larger concern, Scott, and that is the democratization of these things. So when you see a New York Stock Exchange, when you see the CME Group teaming up with these, statistical percentage gaming type betting services, you're saying to yourself, they are entering a new form of revenue stream. And you have to ask yourself, why, after all of these years, are they finding it necessary to enter into new forms of revenue? And I'll answer the question. I'm going to ask and answer. It reminds me of the private equity situation. Private equity has been a accredited investor Regulation D exception to the retail investor. You couldn't get access to private equity investments unless you qualified as an accredited investor. And as we know, that's pretty, not rigorous, but I would say, you either have $300,000 of income as a married person, or you have a net worth of over $1 million, not including your primary home as part of that $1 million. So they were sophisticated investors that could understand a prospectus that wasn't publicly traded, it wasn't on an exchange, and they would be able to assess and make those risks and those investments. But now it's been democratized under the Trump administration, and I'm not holding them accountable or saying they did anything wrong, but it's been democratized into 401ks. And the real public reason that is acknowledgeable, Scott, is that they need more capital. They need access to more capital. Private equity has gone through our country and taken a lot of accredited investors and all kinds of super wealthy investments and bought out the car, wash industry and bought out garage, all kinds of buyouts, dentists and doctors. I was just meeting with a tax attorney this weekend in Orlando talking about her M&A practice, and most of these doctors and dentists are selling out to private equity. This is what they do, and they need more money. They need access to more capital. And the only way to get it was to democratize it into 401ks and to lose all of those accredited investor protections. And that is exactly what I'm worried about. Here is another two groups that make money in a traditional buy, sell, hold, on exchange, report, all of these things. And now they're going to have another new revenue stream for retail investors to be betting on what the indexes should be doing, what the economic indicators will be, how big of a Fed cut will we be getting. I mean, this is wow. This is wow.
Yeah, it's for people our age, it's shocking. And again, it's always only because I've had how many dinner parties over the last 40 years have I had to stick up for these exchanges saying, no, they're not gambling halls. They are places where there's an important economic function that takes place. And I used to use that line all the time when I taught finance at DePaul University in Chicago. But now we've moved into this different era. And you bring up a great point with private equity. Private equity getting into, you can now get into that using your 401k just to make it, easier for the viewer to understand. But these private equity deals are riskier. They're more long term. They take longer, right? So you're not going to get your results like you would if you just bought and sold a stock or bought and sold corn. You're going to be in the deal for the long term. Sometimes there's locks when you can't get out for a certain amount of time. I mean, that's why you have to be an accredited investor to get involved. You have to have an understanding. But now that they've taken away that, and now we've taken away the fact that anybody can bet on, again, how long anybody can keep a job, who's going to win the next election. You'll be able to bet on those things on the New York Stock Exchange, who's going to win the next. I mean, it's a stretch for me to think about why I see the 150 billion that the American Gambling Association talks about and why that's growing at 24%. But at the same time, that's not your core business, and you don't have to be involved in every business, every other thing that's making money out there. You can just be really good at what you do and not venture off into something that, I don't know. This is really unknown territory. Maybe I'm an old fuddy-duddy, but I'm not sure that I would be involved. I get what they want. They want to be involved and get that money, but I just don't know if I'd be going down that path. What say you? Got about 30 seconds.
I 100% agree with you. I mean, stick to your core, functionality of what you're preserving, what you're presenting, the services that you provide, and you're really, a financial medium of exchange that you're tracked. And so is the CME Group, and they're all about, just obviously the Federal Reserve and what the FOMC meetings are going to come out, and we have the CME rate watch. I mean, Scott, this is just so out of their wheelhouse that the bigger and larger question to answer and address is why? Why are these now trying to say, let's get into the game? And maybe it's because you're saying they want to just gain market share of something that's growing, but maybe it's because the traditional financing systems are changing right in front of our eyes, and they're seeing the need to expand revenue streams. And I think it's the latter.
Yeah, well, I mean, they are publicly traded companies, and they do have a responsibility to their shareholders. And I guess if this comes across your desk, you have to give it some serious thought if you're actually running those companies. So we'll see how it ends up. But I tell you what, it's going to be an interesting ride along the way. Appreciate you coming on. Perfect person to have to talk with. Thank you, Rebecca. Have a great week. We'll see you again next week. Rebecca Walser, Wealth Management, coming to us from Tampa, Florida. All right.